Couple I spoke with recently, both 62 years old, were planning to put $300,000 into an annuity for retirement income. But they were completely confused. They had heard wildly different payout numbers. Some sounded decent, others sounded terrible. And no one could clearly explain why the numbers were so far apart. When I showed them the payouts side by side, they weren't shocked by the math itself. They were shocked by how easy it is to end up with one of the lowest paying annuities without ever realizing it. That's exactly what we're going to break down today. Because the truth is, a $300,000 annuity does not have one standard payout.
Depending on the product, rider costs, payout option age, and carrier, plus contract limits and insurer claims paying ability, $300,000 may provide roughly $100 to $2,300 plus servers per month in lifetime income.
Same money, very different outcome. And if you're anywhere near retirement, this difference matters more than most people think. Now, if at any point you want to see what your numbers would look like based on your age, timing, and goals, you can click the link in the description and schedule a quick call. That's exactly what I help clients with every week. But first, let's answer the questions you actually clicked for. How much does $300,000 in an annuity pay per month? Here are realistic ranges most retirees see today, depending on how the income is structured. Scenario 1, the income starts immediately. If you're around 60 to 70 years old, you want income right away. A $300,000 annuity typically pays about anywhere from $1,100 to $1,400 per month for life. This is the lowest range, not because it's bad, but because there's no time for the income benefits to grow. Scenario number 2, income starts after 1 full year to 5 years. If income is delayed slightly, payouts usually increase to around $1,500 per month to $2,100 per month. This is where many retirees land because it balances flexibility and stronger guaranteed income. Scenario number 3, income starts after year 5 to year 10. If you don't need income right away and you can let it grow longer, payouts can reach $1,900 to $2,300 or more per month for life. The same $300,000. It's just structured differently. Now, here's the key thing that most people miss. The payout number you hear first is not what determines whether your annuity works well long term. What actually determines that is how your income is structured. And this is where people accidentally make very expensive mistakes. Most retirees walk into this conversation asking one question: how much does it pay? That sounds reasonable, but it's incomplete. Because two people can both invest $300,000 at the same age with the same type of annuity and end up with far more lifetime income than the other one because they understood what actually drives the payouts. There are 3 main levers that change annuity income by 20 to 60%. Lever number 1, the income rider. Think of many annuities as having 2 values. One is your actual cash value, and the other is an income value that is used only to calculate your lifetime paycheck. Most people focus on the cash value, but the income value is what determines whether you will receive $1,100 a month or closer to $2,000. This is where much of the difference comes from. Lever number 2, when income starts, starting income earlier lowers the payment. Delaying income increases it. For example, a 60-year-old starting income today might see about $1,200 per month. That same person starting income at 65 might see $1,700 or more. Same money, different timing. Lever number 3, the insurance carrier. This is the part almost nobody compares properly. Different companies use different payout factors even for similar products. One carrier might pay $1,450 per month, and another one might pay $1,800 or more per month. Over a 20-year retirement, that difference can add up to 6 figures in lost income. And once income starts, there's no do-overs. That's why comparison matters. Now, something else most people don't realize: a properly structured annuity isn't just about income. It typically does 3 things at once. First, it provides income you cannot outlive, even if you live into your 90s or beyond.
Second, it protects that income from market drops, so your paycheck may not fall when the market does.
And third, it can be set up to continue income for a spouse and potentially pass remaining values to the beneficiaries. That's why, when used correctly, annuities are often a foundation and not a replacement inside a broader retirement plan. Let me give you a quick real-world example. A 66-year-old came in with $300,000. He had already been offered an annuity paying about $1,280 per month.
We compared carriers, and based on this client's age and chosen contract terms, including fees, rider costs, and surrender provisions, found an option quoted at about $1,240 per month, starting immediately. Actual results vary by contract and insurer.
Same money, different structure, very different outcome. Now, not everyone should buy an annuity, but if you're over 55, have a few $100,000 set aside, and want predictable income without worrying about market swings, it may be worth exploring. It fits into your overall income, tax, and wealth plan. And that's exactly what I help people figure out. If you want clarity on what your $300,000 or $500,000 or more could realistically pay you each month, click the link in the description and schedule a call. We'll run the numbers, compare options, and see what actually makes sense for your situation. No guessing, no pressure, just clear answers. Your retirement income should be intentional and not accidental. And with the right structure, it can be. I'm Mark Shelby with Vertical Wealth Management. Thank you for watching, and I'll see you on the call.